Hello guys, welcome back with me. Don't forget to like, comment, share, and subscribe. Considering shares are still trading down 30% from all-time highs they had earlier this year, it's fair to think that might well be trading at a discount here. 2. JP Morgan. Next up is JP Morgan, which trades with a market cap that's about 25% larger than Bank of America. Like their peers, JP Morgan has seen its shares trade mostly sideways in recent weeks as the selling has run out of steam. Technically, there's a lot to like about them right now. Looking at their chart, we can see the stock has managed to put in a series of higher highs and higher lows since July, a technical setup that is almost always indicative of a rally being formed. The stock's relative strength index, or RSI, is also rising as the MACD. This latter indicator has actually just had a bullish crossover and is moving further into positive territory. All this confirmed the move by Peter Richardson at Berenberg, who earlier this summer upgraded his rating on JP Morgan from sell to hold. He viewed headwinds such as reduced banking activity, post-stock buybacks, and raising expenses as fairly temporary, and made the point that much of the downside risk to the bank was already priced into shares. Further confirmation that these headwinds are dissipating will do much to push shares up and out of recent consolidation patterns. 3. Goldman Sachs. Last but definitely not least, Goldman Sachs, which is by far the best performing of the three stocks in the article, while Bank of America and JP Morgan shares are down 20% and 25 respectively since the start of the year. Goldman shares are down just 15%. They have also rallied the most in recent weeks and were at point up a full 30% from the lows of July. Fundamentally, Goldman has earned a strong reputation on Wall Street for having one of the better diversified banking businesses. They have multiple revenue-generating verticals like investment banking, global markets, asset management, and wealth management, all combining to deliver more than $11 billion of the revenue on quarterly basis. This diversification means they are not as exposed to cyclical fluctuation and is one of the core reasons their shares have outperformed most of the sector this year. For those looking to get involved in some banks but are hesitant to buy any stock that's down more than 20% this year, Goldman is a solid option to consider. Weekend stock may barely consider oil sell of cold extend Bitcoin to under 10%. After both the and Dow Jones completed their worst week since 2020, on Friday markets could be primed for a corrective rally when trading reopens on Tuesday after the June 10th holiday. So our narrative is filled with gloom and doom, and longer-term investor expectations seem to be extremely negative. Stock then tumble in a straight line. Therefore, we're anticipating a short-term rebound within the longer-term downtrend. Weak indicates weaker SPX sectors. Over the past 11 weeks, the SPX registered its 10th decline as they entered a bear market. The broad benchmark is down 24% since its January for all-time hike, sinking below the expected under 20% level considered to be an official bear market indicator. When then are we predicting a possible bounce as early as this coming week? When broad sentiment is highly bearish, it increases the likelihood that whoever wanted to sell has already done so, leaving demand in charge. Technicals are helping confirm this. Not to that significant support such as this often reached beyond a straight location as traders try to beat each other to the punch. There could therefore be another weekly decline before a likely rebound if we don't experience a short-term bounce this week. Significantly, the decline of all 11 sectors immensely during the past week demonstrates the aggressive nature of the fall, which also primes the index for a rebound. As well as on weekly basis, all 11 sectors are lower over the previous month and the past 3 months. The single bright spot is energy sector, which has been up over the previous 6 months. The remaining 10 sectors are deeply in the red, with utilities and consumer staples, nonetheless, and consumer discretionary, communication service, and technology shares taking the brunt of the sell-off. The yearly view shows the 6-month view. Maybe that's all for me. Don't forget to like, comment, share, and subscribe. Thank you.